Now, without any further delay, I would like to introduce our amazing facilitator for today, Amit Jethani, who is the co-founder of Mantle, an AI-powered equity management platform. Previously, Amit was the director of the core services vertical at Autonomic, focused on building a connected vehicle platform for Ford Motor Company. And then he played a pivotal role in the company being acquired by Ford Motor as well. With a unique background in engineering and business, Amit has vast experience in various industries, including but not limited to education, automotive, retail, and online dating. Amit, it is a pleasure to have you here, and I welcome you to begin the session.
Wonderful. Thank you for that generous intro, Alina. Hey, folks, happy to be here and happy to walk you through what is probably going to be one of the more complex and esoteric things you need to worry about when it comes to your startup, but it's also one of the most important. So I will share my screen and walk you through it. There's a lot of content to cover, and depending on time, we might even go through an actual spreadsheet based exercise. So you get to watch me struggle with numbers in real time to kind of show you just how strange and complicated that this world can get. So give me a second here. I'm going to switch to presentation mode and get us going. Okay. Cap table management. So Alina already covered the intro piece, but I'll add one little detail there, which is our co-founding team, which is one of the larger co-founding teams you've probably heard of. We're 9 co-founders. We've struggled with cap tables across every startup journey. So we knew we wanted to build something to make this better. And that's really the motivator for why we built what we did. So now I'm going to walk you through sort of the educational element of it, where you understand and learn the mechanics of a cap table and how it relates to setting your startup up for success when it comes to investment. And then we'll see just what are some of the questions come up, and we'll navigate from there. So the agenda here, broadly speaking, is I'll just very briefly touch upon fundraising and valuations. What is a cap table? What does diligence mean? We'll talk about convertibles and some corporate securities, and we'll do a pro forma exercise. Now, for every section, what I've done is I'm going to give everyone a very brief overview, and then I'm going to link to some reference material. And that's because our teams put together some amazing reference material. You can just think of it as homework that gets assigned to everyone, because it is a lot of detail that we're probably not going to be able to cover in an hour-long session. So let's jump right into it. Now, if I were to zoom out and look at the overall investment process, this isn't by any means a deterministic process, but let's just think about it at a high level. When you're thinking about fundraising for your startup, there's a lot going on. You're obviously building your product, you're developing your team, and you're doing all of those things. But then when it comes to the fundraising piece, especially as a founder, this is going to be top of mind every so often. And in this phase, you're thinking about introductions. And this is where we recommend always be fundraising, like always have that mindset of we're going to be fundraising. I'm taking calls, I'm getting intros to VCs. Unless your network is fully developed and you know exactly who to call, you will probably have to go through a bunch of different intros and pitches in order to land funds for your company. Once you're making some progress there and getting some traction, let's say you have a second or a third meeting teed up with an institution or an institutional investor, or it could be a solo investor, of course, you're probably going to have to go through due diligence. And by probably, I mean almost always, unless they like completely trust you or something. And due diligence is a very important part where you effectively develop a data room. And data room is basically a collection of all kinds of documents that relate to your startup that help someone understand the full story, right? So it's got team bios, financials, any contracts, partnerships, etc., all collected into a single location. The idea being that counsel on the other side, who's representing the institution, can review everything and make sure things are in a good spot before a check gets written. And a big part of diligence is the cap table itself. So the cap table needs to be organized, it needs to be tied out because it is the it's the source of ownership information in your company. And obviously, any new investor stepping in to participate will want to know the story of that ownership before they choose to participate. Uh, Once you're past that, you may be in a good place. That's where you get to have fun with the round allocations. You may have a bunch of investors; they're all interested. You're trying to figure out what the participation amount needs to be in order to hit your target. And there are some cap table exercises you can do to help you figure out that allocation. So we'll go through a very simple pro forma example to give you an idea of what that process looks like. And once you pass that, you close your round, put out a press release, and go build your thing. So start with valuations. The concept of a valuation is really important because effectively the the whole investment process centers around what is your company valuated at, right? And valuation is represented in either what's known as a pre-money valuation or a post-money valuation. Don't worry about that, the technicals just yet. We'll cover some of that detail. It refers to what's known as conversion timing. But effectively, what it's saying is, what is this company worth overall? And then you break that down into a price per share. And you will see this referenced as a strike price or an exercise price when you're issuing stock options, or it's simply a FMV or a fair market value of the company's stock, like price per unit, effectively, right? And we have a write up here. So as always, I'll give you a summary and we'll link to detailed references if you have more questions and follow ups that don't get covered in this session. The important detail here with valuation is to get an accurate assessment of your company's valuation. In Canada, you can actually just pass a board resolution. And of course, for very early stage companies, the board members are effectively just the founders, and sometimes it's just one founder, like the CEO, typically. Uh, but in the U.S., or if you're hiring people in the U.S., like you're a U.S. entity or you're hiring someone in the U.S., you will need a 409A valuation. So that is basically a third party opinion on your company's valuation. And you will basically get an audit firm that you hire who will go through all your stuff and land on a report that lists the price of your company's common stock. So having that context in mind will cover like some of the other pieces, right? So now let's get into like what is a cap table, right? A capitalization table, or a cap table as it's commonly known, tracks the most valuable and finite resource in your company, which is the equity. It's recording the ownership structure, which is broken down by a bunch of different corporate securities: share grants, option grants, safes, convertible notes, warrants, et cetera, et cetera. There are a lot of different securities out there. We'll just touch upon some of the more common ones. But of course, this can get really fancy and bespoke depending on the law firm you work with and more. So, how do cap tables get complicated? When your company is really young, things are probably really simple. You're thinking about it in percentages. You're saying, oh, it's just me and a co-founder, maybe a couple of co-founders, and we're going to split it half and half or a third each. Or maybe there's certain, ratios like whatever, like 40, 40, 20 or whatever, depending on how much time and what effort founders are bringing to the table. It starts off very simple. But then you go through a single financing round and you jump from 2 or 3 stakeholders to 30 overnight. This happens very quickly. And I know it seems like hyperbole, but this is actually a very common scenario because when you go through a financing round, a lot of things are going to happen all at once. You're going to get multiple investors participating. You may have a SPV, which rolls up friends and family. You may have some founders themselves saying, I would like to put some cash into the company early on. You're going to have employees board members, consultants, advisors, etc., who get option grants, so on and so forth. So there's a lot there from a compliance standpoint where cap tables can get pretty complicated. Now, one common question that comes up is percentage ownership, right? And this is a really important point to drive home. In the early days, it's okay to reference your cap table as, oh, there are only a few, like three of us, and we get a third each or something. But technically, that's not an accurate cap table. A cap table will have quantities of shares, and I'll show you an example cap table later where you'll see this. And from that quantity, the percentage is calculated, right? So this is really important to understand in terms of like cap table mechanics, um, because the because percentages are the outcome of a cap table. And the reason for that is corporate securities reference quantities. That's really the genesis of that, right? So now let's look at who is on your cap table. First of all, let's talk about equity generally speaking, right? Like your company ownership. I mentioned earlier it's an important and finite resource in your company. There are a few different analogies here. We like to use the toilet paper analogy, but I'll go with a battery this time around. So if you think about your company equity as a fully charged battery that you can't recharge, what typically happens is when you start off, you've got 100%, and you're giving away chunks of it to early founders and employees and advisors. But then as you get closer and closer to the finish line, you're going to start to get a little bit careful, right? If you think about how you use your phone or your other devices, when you're 100% battery, you're just using it max brightness. But then when your battery starts to dwindle, you're getting clever with it. You're turning off Wi-Fi, you're turning off data, you're reducing the screen brightness, so on and so forth. And this is a common pattern. And a lot of it happens because, one, it's hard to plan for these things. Part of it being it's hard to predict the arc of where your company is going. Plus, we felt that there weren't enough tools in the market to help you do this. Of course, you can always use a spreadsheet, but then you need some expertise in order to do that. So this is something that you have to keep in mind. The other thing to consider is when you have founders, specifically founders, but really this applies to everyone like option grant holders and such. It's important to consider the concept of vesting, right? So I won't have a lot of time to get into the details of how vesting schedules work. We have a write up on it. I can link a reference, but basically the idea is when you grant equity to someone, you don't give them the entire quantity all at once, right? Like, think about salaries as an example. If you were to hire a salesperson today, you wouldn't pay that person 4 years of salary all at once and say, uh, welcome to our company. Please work hard for the next 4 years, right? Like you would pay them a salary that gets paid out over months or weeks or whatever your payroll schedule is. And that's really important to keep in mind with equity as well. It's the same idea. There are different mechanics between vesting and reverse vesting, but the idea is that if someone were to leave, you have to hedge against it, and your investors will pretty much demand it for protecting the ownership in the company. You can't have someone leave and walk away with 40% of the company. So there are ways to hedge against that by employing vesting schedules. So I have this visualization. There are many analogies here. Pizzas and pies are very common, but I'm just going to go with this little block diagram. When you start a company, you create a total pool of what's known as an authorized share count. Now, in Canada, this is simple because you can just say unlimited authorized shares. But in the US, you will have to set a limit. But regardless, it's really about understanding that there is a maximum number of shares that you can issue. And you can think of this as like your total pool. But then what happens is you create a new share class. And share classes are basically segments that all add up together to construct your cap table. So your first segment is most likely going to be common shares or common stock. And the shares versus stock is really just lingo difference between US and Canada. So common stock is typically reserved for founders and very early investors, like your angel investors. Generally speaking, it's just founders. But then you're going to create another carve out for an option plan, right? So what's happening here is you're still staying within the boundaries of your total authorized count, but you are carving out a plan for um, employees, board members, consultants, advisors, et cetera, right? And this is another important cap table mechanic to understand is when you add people to your cap table, and it could be anyone really, you're always issuing new shares, right? So thinking about a pizza real quick, the pizza gets bigger, but your slice of the pizza gets a little bit thinner, is one way to think about it. So that's why what I mentioned earlier with respect to percentages, it starts to get inaccurate and very difficult to track over time. And that's why you have to go back to raw numbers and then compute the percentage after the fact. After carving out your option plan, you're going to start issuing preferred shares. Preferred shares are typically reserved for investors. There are many cases where founders will also get some preferred stock, typically to retain voting rights. And there's some cases, interesting scenarios there. But for simplicity, you can think of it as preferred shares are typically reserved for investors. And the total sum of your common shares, your preferred shares, and your option plan is what is known as total outstanding shares in your company. Once you have that number, you compute the percentage, right? Like I have 100 shares in a company with total outstanding 1,000 shares. That is 10% ownership. So actually, before I move on to the stock option, please, piece, are there any questions so far? I know I covered a lot, and it's very dense, but any questions with respect to shares, share classes, allocations, or anything else so far? I see a
Uh,
couple. Yeah.
yeah, I was just going to say there are a couple in the chat.
Yeah, sure.
Lara's asking, how does all this dilute as the original founders?
Yeah. The dilution is effectively in the fact that you're issuing new shares, right? So let's say if I go back to this scenario, let's say you just incorporated, you issue common shares, and there's nothing else, then your total outstanding share count here is equivalent to your total common shares, which means the founders at this stage own 100% of the company. Now, the dilution comes in when you issue new shares. So let's say I want to issue brand new shares to carve out an option plan. And carve out is an unfortunate term. That's typically how it's referred to. But what's happening here is you're actually issuing net new shares. So if you imagine this as a Lego block, it would be on top of the yellow, right? And maybe I'll fix this visualization to clarify that. But effectively, what's happening is let's say at this stage, there are 1,000 common shares. That's it. That means founders own 100%. At this stage, I'm going to issue an extra 100 shares for common stock, which means the total outstanding share count in the company is now 1,100. And then you recompute the percentage. And of course, at this stage, the founders don't own 100% of the company. That's your dilution. And then you issue new preferred shares and you add it all up, you get an outstanding share count, and now the common shareholders own even less of the company, so on and so forth. Every time you issue, you're increasing the size of your pie, and your slice of the pie gets thinner. The hope is, of course, for a lot of venture backed startups that you just knock it out of the park with your company's valuation, so that when you get a meaningful exit, your very thin slice of the pie is still worth a lot. Next up, where would advisory shares fit in the share classes? There's a mix here. Generally, we see it under the option plan, which is what I would also recommend. But in theory, you're not really restricted to which share class you allocate, right? You just have to sort of look at it almost on a case by case basis. Like, for example, if you have a very high leverage advisor who's effectively a founder, but maybe not there full time, and you want to issue common shares to that person, sure, go ahead. Or you have an advisor who is also writing investment dollars into your company. In that case, it goes under preferred. This gets into legal territory, and we're not a qualified law firm here. But generally speaking, it comes down to where do you see the person fitting into your company is how you're going to determine that. Let me see. Next up, can you clarify the option you mentioned friends and family would roll into? Uh, let's do that at the pro forma exercise. Okay. Effectively, you can Google special purpose vehicles. It is effectively a basket of investors that you collect with what's typically known as small checks. And then that way you only have one line item in your cap table, and they would go under the investor bucket. What is the best practice percentages for angel or early investors in common shares? Hard to say. A common rule of thumb we've seen is every time you go through an investment round, you don't want to give away more than 20% of your company. Of course, that's going to fluctuate. It depends on a lot of factors, how mature the startup is, what industry you're in, like health tech versus fintech versus if you're a consumer product. There are too many variables there to try and give you like a prescriptive thing. Of course, the real tension is between founders not wanting to give away a lot of percentage and investors obviously wanting to take a lot of percentage, but still ensuring that founders are continue to and incentivized to continue building. For the 4 original partners, I will cover that in the pro forma exercise because I think just understanding the mechanic of dilution will help you with a lot of like cap table math, and then you can answer questions like that very easily. Let's continue. I'll go to the stock option plan piece. And this itself, it's a pretty big world. But a stock option plan, commonly acronymized as ESOP in Canada, is basically a way to incentivize employees, board members, and founders themselves. The idea here is that the type of security you issue is an option. And the magic of issuing an option grant is that it gives the, I'll just say employee for simplicity, the employee the right to purchase a specific number of shares in the company at a predetermined price. So what that means is if the employee chooses not to purchase those shares at the exercise price, then you don't really lose any equity in your company. But if the employee chooses to exercise or continues employment, then they would only after they exercise, they would actually get shares in the company and end up on your company's cap table, right? So that's it just creates that additional layer there. The strike price or exercise price I covered earlier with respect to valuations. That's where it gets set. So that is the way the contract would be structured. As always, make sure you have a vesting schedule in place. Common question we get: how large should your option pool be? It's tricky to answer this question. We've seen numbers from 5 to 25% for each financing round. Okay. So again, I'll explain this in the pro forma piece where basically what's happening is when you take on new investment dollars, the investor is most likely going to ask you, okay, what's your option plan look like? How are you going to incentivize future hires and yourself to continue employment and align incentives? And the way you would do that is by continuing to carve out a percentage per financing round. 10% is a very common number. And again, this is like a rule of thumb, but we've seen a pretty wild range, and it's going to depend on a myriad of factors, right? Like a late stage company probably isn't going to carve out a very large percentage versus an early stage company. The reason why you would want to do this really is attracting, retaining talent, fostering a culture of ownership. It's nice to have employees who are also owners in your company, and it just helps you align with long-term goals. We have a write-up on how you want to start thinking about your option plan proactively, so feel free to use that reference. So how do the options work? The mechanic here is that, I'm really summarizing here. You would work with your law firm to make this happen. but effectively you would have a board resolution that adopts an equity incentive plan. The equity incentive plan would have a bunch of, let's call it, bylaws and guidelines on what you can and cannot do with the grant. And then you get a much simpler document, which is the option grant itself for the option holder, right? The employee, board member, et cetera. Make sure you set a vesting schedule. A very common sort of Silicon Valley inspired vesting schedule is a 1-year cliff followed by 148 thereafter. And effectively, what that means is, let's say I give an employee 1,000 options. For the first year, that employee is going to get 0. And then right after the first year, the cliff period, the employee gets exactly 25%. So 250 units right away. And then past that, the employee is going to get a thin slice every single month for the next 3 years. So the idea is that over a 4-year period, the employee will get all 1,000 units. Tracking employee exercises can start to get complicated. These are the kinds of things you have to think about. And there are a few other nuances. I'm not going to cover it right now. I know it's a lot of detail, but at least at a high level, I hope that clarifies what option grants are. Now let's talk about diligence. This is probably, and unfortunately, one of the more stressful things a founder will have to go through when navigating a financing round. Of course, all of it feels stressful, but the reason why diligence ends up being particularly gnarly is because it's going to come up at the 11th hour, right? Because think about the whole process that I showed earlier. You've had all these conversations. You've showcased your pitch deck. You're talking to the VC. The VC likes your product, likes your team, and is now interested in writing a check. So the VC is going to say, "Let's just run through diligence. If everything checks out, we'll sign the security, typically a safe in the early stages, and send over the money, right?" And you also have a term sheet in there a little bit earlier in the process. So during that diligence process, what's going to happen is a law firm on the other side, right, the law firm representing the institutional investor, is going to check everything. And I mean everything when it comes to your cap table. The most important thing there is going to be the cap table needs to be tied out, which means every single number on your cap table needs to map to a document, right? You can't have fiction in there. And that's why we have this like broad disclaimer, like verbal agreements aren't real. Sometimes legal agreements aren't real either. And the reason why I say that is because imagine a scenario where you sign some founder shareholder agreements amongst just 2 or 3 people, but then one co-founder left. And now the investor or the law firm is going to ask, okay, what happened? Did you end up repurchasing, canceling some of the shares? What did you do? Do you have documents to back that up? And does that now reflect in the new reality of your present cap table? So that's just in a very sort of simplified example of where you really want to make sure that you have documents in place that back it all up. And as always, we have a write-up on cap table hygiene. I will pause for a second there before I get into convertibles. This is where we're going to get into numbers. Questions on diligence or option plans so far? And also take any feedback on the pacing. Am I going too quickly? Am I going too slow? I know for some people this is going to be a first time, and for some people this is going to be very obvious, but yeah. All right, let's see. How do we get access to the reference links? I believe Alina will help us circulate post session, and then you can actually click on these links that will take you to our blog where we have these write-ups. Okay, no questions. I'll continue.
Sorry, I see Catherine raise her hand. So Catherine, will go to you. Sorry, Amit, I didn't mean to
Yeah, keep
interrupt.
going. Yeah. Hey, Catherine.
Sorry, yes. I just have a quick thoughts when you said your cap table needs to be tied up with documents that back up for that purpose, but also do that's your investor needs to check with your accounting system to find out whether your chartered accounts is actually matching up with your legal documents. like money in and out, not just document itself, but actually the payment or receiving it? Do
That
they check on
depends.
that as well?
Yeah, that depends. Some investors will go that far in the sense that they may not check every single transaction because that's a lot of history to capture. But what they will do is ask for your financials, right? So when you publish end of year financials, or they'll ask for audited financials as an example, an accounting firm is going to go through your financials, report on your cash position, and then it's going to be obvious whether or not the money landed, right? So if you have a, let's say, three safes, 1 million each, and you and then when the accountant's looking at your financials and saying like, wait a minute, like you didn't start with $3 million, what happened there? That's where that would get flagged.
Thank you so much for your time. Explain that.
Yeah, of course. Let's see. I see a little chat bubble. Do you do due diligence at the angel investor level, and what depth of info do they expect? Uh, It depends. So some angels are friends and family. In that case, they are most likely investing in you as a person. And the expectation is that they know you, they trust you, that you will do good by the money. And they probably are not going to go too far or too deep in the diligence phase. In some cases, you can have like someone a little bit outside your network who needs to sort of probe into the company. The thing is, at the very early days, there may not be much to conduct diligence on, right? Like if you just got incorporated and maybe you have a basic cap table with two people on it, there isn't much diligence to do at that point. So the my expectation is that the diligence would be much more focused again on the team and their ability to execute and the problem space they're tackling and such. A lot of that gets covered in your pitch deck, basically, right? And that's about it, really. Okay, let's talk about convertibles. So convertibles are, broadly speaking, a set of securities that get signed, or financial instruments, if you want to think of them that way, where an investor is basically going to write you a check and get a document back in return. And that document is going to outline the terms of ownership, where what you're effectively doing with a safe, simple agreement for future equity or a convertible note is you're saying, give me the money today, but the percentage that it's going to convert to is something I will calculate in the future, right? So what you're doing is you're decoupling the ownership percentage calculation and the whole exercise and basically punting it into the future. And the reason why this is helpful is because it just makes you move a lot faster, right? Because in the early stages, like for, let's call it a pre-seed or a seed round, a bunch of investors will very happily sign in on convertibles and say, we think your company valuation is X, and as such, I'm willing to write you a certain quantity of money. Um, let's worry about the ownership stuff and the share certificates in the future when you have a price equity round or an exit or some other material change in your cap table. We have a reference link here if you want to go deep into how these documents are structured and why they're going to be relevant for you. But broadly speaking, the reason why you want to do this as a founder is it's simple, it's flexible, and it's not a debt instrument, which means there's no interest rate. For safes specifically, convertible notes do or usually have an interest rate. So what ends up happening there is if an investor gives you money, there's no expectation of like, oh, I will get 4 or 5% back yield or whatever, right? It's really just, I'm going to get a slice of your company when you calculate it in the future. That's effectively what's happening here. So how does the safe actually convert? This is going to get a little bit technical, but at a high level, what's happening is a safe can have one of like there are a few common flavors, right? So this was an innovation from Y Combinator about 11 or 12 years ago, and effectively what a safe gets structured as is it could have a valuation cap, it could have a discount, or it could have a combination. And a valuation cap is basically saying that this investor will get a certain number of shares based on the valuation, regardless of what the price round is. So, to put that into numbers, if I'm an investor and I sign a safe into your startup at a $10 million valuation cap, then in the future, if your company raises money at a higher valuation, let's say 20 or $30 million, for me, the math is going to be based on 10 million, right? So that's the benefit I would get as an investor for coming in early. Discount is a same idea, but you just get a percentage off, right? So I would say I'm an investor, I write a check in your company, and I'm expecting maybe a 10% discount on the share price. What that means is in the future, when you raise at whatever, $20, $30 million valuation, you will calculate a share price, and I will get shares that are 10% discounted, or 10% more, depending on how you want to think about it. And then the val cap and discount basically combines the two and just gives the investor the better deal, right? Like you do the math both ways, and then you figure out what gives a higher number, and that's the mechanism for conversion. So again, we have a detailed write-up here, but for this piece specifically, I will also show you a calculation quickly. So let's do this. I know we've got 20 minutes left. Let's see if we can get through this quickly. Let's start with a sample cap table, right? So if you've never seen a cap table before, this is what it looks like. Typically, it's in a spreadsheet, right? But I'm showing you an example of what it looks like once it gets set up in a platform. So what we have here is a company, started by Michael Scott himself. He decided to bring the paper company into the AI age. You've got two founders with a 50-40 split and a 10% option plan. Okay, that's it. Very simple. 50%, 40%, 10%. To get the ball rolling, they got an investor to come in with $5 million at a $20 million valuation. So really cashed in on their celebrity status there. Now they're burning through the money, they're hiring people, and they're thinking about what's next. What is that next stage? And the next stage for these founders is they're thinking about raising another $10 million. Okay, so that's the setup. You've got a company, they have 5 million in the bank, 50-40-10 split, and now they're thinking, we're going to hire employees, we're going to give out option grants, and we're going to raise an extra 10 million. So let's go over the impact on everyone, really. And this will also help answer the question of what happens when a founder leaves and such. Okay, so just going back to cap table math and how I describe the safe conversion piece. We know that this company raised $5 million at a $20 million valuation cap. And for some of you who understand this language, it's a post-money valuation cap. What percentage does the investor get? So I'd love to see some guesses in the chat. What is the percentage that this investor gets? You can even just sort of unmute and sort of say it verbally. And yes, it's true. This is Dwight's dream coming true. Nothing yet. Maybe I jumped too far. Let's see. I see 25%. Any other numbers? Any other guesses?
I was guessing around 20% as well.
Okay. So people are in the ballpark, which is great.
Yeah, me saying 25 as well.
Okay, I see that.
23 or post money valuation?
It's a post money valuation.
Okay.
So when I get to the spreadsheet, I'll sort of explain what's happening here. But the answer is also it sort of depends, right? And I'll show you what I mean in the spreadsheet, which is if this company were to exit at 20 million, then yes, indeed, this investor would get 25% of the company. But what if they were to exit at a higher valuation? Do they still get 25%? right? That doesn't make sense. And that's the nuance we're going to cover in the pro forma piece, and why calculating a pro forma is important, because in the early stages the math feels very simple, but it can get horribly wrong as your company evolves. So let's get into that piece, right? So we know that we've got this single investor already in place, and I asked the audience this question. I got 25%. That's a good answer. Let's park that. Okay, we're going to come back to it. But now let's talk about the new investor, right? How do you solve for this? So the brand new investor is going to come in and is offering $10 million at a $50 million post-money valuation, right? We're obviously talking about the happy path here. The startup is up and to the right. They're growing. It's a rocket ship, lots of interest. And for simplicity, let's just say it's just a single investor. But of course, in the real world, you're going to get multiple investors, and the total participation is what you're going to calculate things on. But if the new investor comes in with a 10 million at a $50 million post-money valuation, what percentage? Actually, we'll get to the spreadsheet and go over this piece, okay? But this is the layup of the problem, right? There's a few different ways to solve this. One easy way is just call your lawyer. If you have the money, call your lawyer. The lawyer will take care of it. But there's another way, right? What if you had to do it yourself? So let's pop into Google Sheets real quick here. So I'm going to stop my screen share and flip over to a spreadsheet. And I think you will enjoy watching me struggle with a spreadsheet, but here we are. So the setup, again, is the sort of the 50, 40, 10, what I described. But remember, 50 and 40 are the founders, right? So I'm rolling up the founders under common stock, hence 90%. And then the option plan, I've broken it down. And the reason why I've broken it down is because the option plan is a carve out, yes, 10% of the company, but you're going to have people who've already got options in the company, like they've already hired people. And then you have options that are available in the company. And the reason why you want to break this up is because when you have a post-money option plan target, you're actually targeting this row. And I'll show you what that looks like, right? So given where the company is today, I asked the audience 5 on 20, what is the fully diluted ownership? Yes, it's true. It would be 25%, right? But that's assuming the company exits at $20 million. But for my price round, so I'm raising $10 million at a $50 million price round. And the other parameter here is that I'm going to target a 10% option available, right? So now you can see how this gets complicated. I've got employees who've already got options, but after I take in the new money, I want to make sure I have another 10% allocated, right, for future hires, because this is a growth stage and the company's going to hire tons of people. What does that look like? And of course, this money is coming in from a new investor, right? The new investor who's going to bring in $10 million at a $50 million valuation cap. Now, the way you would, there's many ways of calculating this pro forma. Of course, you can use some online calculator, but then you really have to understand the lingo and the mechanics. You can use a spreadsheet, and that's the part I'm going to show you now. So with the spreadsheet, what's going to happen is the first thing you're going to start off is setting your target percentages, and then you're going to add up your fully diluted percentage, which obviously has to add up to 100%. You only have 100% of the company to give away. And then we're going to look into what the actual OS stands for outstanding, what the actual outstanding share count is going to be for every single person, right? And from that, you compute the new percentage, etc. So I'll go through this pretty quickly in the interest of time, but the expectation here is, because it's a post-money safe, new investor is going to come in 10 on 50, which is really just a 20% target, right? So I know that after all my cap table math, this investor should land at 20%, right? So what that means is this investor is obviously going to get diluted down, right? So this is what I said earlier, which is it depends. It's 25%, but really it's going to get diluted down a bit. What does it get diluted down to? That's the tricky part. So first thing we need to do is figure out how many shares we're going to give this investor. This investor, remember, is converting at a $20 million valuation cap, right? So this is the exact process, by the way, right? Like I would guess. Of course, if you're very fancy with Excel or Google Sheets, you would use linear solver or some other sophisticated mechanism here. But I would actually just start guessing. And I wouldn't be surprised if that's what your law firm's doing behind the scenes too. But let's go through this quickly, okay? Let's start with 3 million units. Okay, so I'm getting close, right? 24.3%, not quite 25. So I know I need to go a little bit higher. Maybe it's 3.2. Overshot it. Okay, let me do 3 point. Actually, hang on. What needs to happen is this is going to be 25%. You can see how complicated this can get. It's going to be okay. Yeah. Let's leave it at this number for a second. Okay. We'll dial in the decimals as we get closer, right? The real challenge is in figuring out how many new shares I'm going to issue. And this is where cap table math gets complicated, right? Because think about what's about to happen. I'm going to guess numbers of how many shares I need to give this brand new investor, right? So that the percentage for this new investor over this pro forma total equals 20%. So you can see the circular math here, right? I'm going to increase this number. It's going to go up, which means this number is going to go up, and that percentage is going to change, right? So let's start with the guess here. Let's start with 2 mil. Okay. So it's only 13.85%. This investor is going to get a lot more shares in my company. No problem. Let's go with 3. Okay. Getting there. Let's go with 3.2. Oh, overshot it, right? So you can start to see why this is complicated. Do 3.1, getting there, not quite. But then the other complexity is I also need to worry about the option plan, so on and so forth, right? So it's going to take me a while to sort of converge. But let me show everyone just very quickly how you could do this if you were to use a piece of software. Basically, I have this sample company set up on our platform, Mantle. And in Mantle, if you had to go through that exact same exercise, what you would actually do is just go to the term sheet modeler and just quickly type in the deal terms. Like if you had a term sheet, you would obviously just throw the PDF in here. But in this case, I'm just going to type in the deal terms and say that I'm getting $10 million at 50 million post-money valuation cap, 10% option pool size. I go to pro forma and I get a pro forma cap table in seconds, right? This is exactly how many new shares I need to issue so that the investor comes in at 20%. So you can see my spreadsheet numbers were off. But of course, if I spent more time on it, and unfortunately, a lot of founders end up spending hours on this, or of course, you get your law firm to do it. They will spend hours on it and just send you the bill. You will land on a specific number, right? And it also shows you how many new shares you need to issue for your equity plan. What do the safe holders convert at, right? So that's the first investor who would have got 25%, but then the investor got diluted down to 18.4% because the new money came in. And you can see now for the founders, okay, they went from 90% to 49.69, right? So that's massive dilution for the founders. And this is where you can have some of the more difficult existential questions of like, do we need to raise that much money? Can we raise less? Do we negotiate deal terms, et cetera, right? But having the numbers lets you set some guardrails around where you want to be. I'm gonna like pause here. It's a lot of information, and I know we only have like 7 minutes to go. So I will open it up to questions and such. Hopefully that was helpful. Yeah.
This was great. I think it was really nice seeing how you're doing it on the platform. Super, super valuable. All right, let's open the floor to questions.
Okay, so I see a question from Dominic early on. If you use a safe, would it convert at the same value of the price round? So that depends on the valuation cap on the safe. If you happen to have a price round that has the exact same deal terms as your safe, then we'll convert at that. But basically, the conversion of a safe is based on the deal terms described in the safe itself, right? So hopefully that's helpful. But of course, if you have detailed questions around like how it converts, we have the reference material, or reach out to us separately. Let's see. Yes, a lot of people do use Microsoft Excel, understandably so. It's the lowest barrier to entry, but the problem is you go from 2 people to 30 people, and it's going to start to get really complicated. I see Ariana with a question.
Yeah. Hi. Yeah, my name is Alessio. Ariana is the name of the company.
All right.
The question was, is your software a subscription-based software? There's a monthly, but how does it work to
Yeah, for sure. So we actually have yes, it is a subscription model, but we actually have founder-friendly pricing. So we don't charge you more for every single stakeholder you bring in, and you will see this with the competition. We keep it very simple, and we actually have flat rate pricing. So if you're interested, you get the first year free, white glove onboarding, and flat rate pricing that you get to lock in.
Okay, cool. And I guess I can see all of that on the website, or where can I find the pricing? Website is a good place.
It's on our website. It's $100 a month. It's very it's really simple, and that's for the company.
Okay, thank you. Appreciate it.
Catherine, go ahead.
Thank you, Alina. Amit, I thought you have that scenario for this those evaluations. Like when you mentioned that if you brought in this investor for 25 million to like 20 million to rise to 50 million valuations, and then your common shares dropped down less than 50%. So you lost that's a loss your control to your company, or because you're less than 50%. Now, if you set up the system, how do you alert yourself, like to know, or alert to any founders who were 90% dropped on 50, like 49%? And what's the decision making there, alert to help you to make the decision whether this is the good funding, like for your own benefit? Because you get more money, you got this interest rate, and then your profit couldn't accommodate this much money, and then you lost control of your company as well. So this is the really, like, did it have any suggestions on that when you actually do the calculations? Any alerts? Any
Yeah, for sure. I
advice
think
on
that,
in your software?
yeah, there are quite a few considerations there. The big ones to think about is before you even start fundraising, you want to think about what is the correct number of dollars you need to raise. And correct obviously is a relative term, but fundamentally what you're trying to get at is figure out exactly how much money you need to get to the next big phase in your company, whatever you've described, and set your personal like your company targets and goals as, right? So for example, if I'm running a retail type of startup and my goal is to expand in the US with 10 retail stores between now and let's say the next 12 months, I can do some back of the envelope math and try and get to a certain number and say, you know what, I think I need maybe $3 million for it. Then I need to hire like a couple of people. I need retail staff, blah, blah, blah. I need to give people salary increases. I need a bigger office, blah, blah, blah. I think I need 6 million, right? And maybe I'm going to add some buffer there to hedge against poor economic environments. Let's go with 6.5 million. So the first thing is the discipline of figuring out how much you need to raise. And then the second piece is what percentage are you comfortable giving away? Now, of course, for a company where you don't have a lot of choices, maybe you're running out of cash, and based on your cash flow, you do need that influx of investor money to keep things afloat. Maybe you take that sacrifice and you say, I will give away a big percentage. Again, it's percentage of ownership. In terms of like control of your company, you could decouple it. You would work with your lawyer and create like a fancier agreement where you create a new preferred share class that has sort of like super voting rights. So it's like, as a founder, just as an example, I'm really simplifying here, but if I have, as a founder, I have 1 share, it maps to 10 voting shares or something like that, right? So there are ways to hang on to control, like leadership control of and governance control of your company, but you've still given away a lot of the ownership, right? So there are ways to hedge against that as well.
Perfect. So there's a possibility to say I have a 1% of this company. I can still have a total control of many things, but I want willing to give in many common shares or preferred shares just so I can make the bigger pie expansions on that purpose, right? So that would have to work out with the lawyer on that. So
Exactly.
if that number's plugged into your system, would it give you advice? Say, okay, to make you like make a decision on that. Because
Yeah.
if
So
if it's just a number plugging, and then if somebody just brand new here wouldn't know whether it's going to affect his rights in the future. But if you said if you do have those legal documents to make sure that you have a 1% control rights, and then give away 40 40%, close to 40% to someone else as a new investor is a good strategy for expansion.
yeah, like so there's two parts to it. One is what is within sort of compliance and legal guardrails, and as you can imagine, the legal guardrails here are, of course, you're welcome to give away a large percentage of your company, right? Like it's not problematic from that aspect. But then to your point, in terms of like making a founder aware and sort of spotlighting, like, are you sure you want to give away so much of your company? That is something we are working on, because it's a very delicate area of like founder to founder level advisory. Because fundamentally it comes down to, for some companies, that is the correct decision and that is the obvious decision. And again, it depends on the industry, depends on the stage the company's at. Maybe it's a first-time founder, and it's hard getting traction based on the industry they're at, etc. Versus for someone else where it's like, okay, yeah, that number looks way off. But fundamentally, keep in mind, a piece of software is never going to replace a set of professionals, right? Like we're not going to replace a law firm, accounting firm. And one of the real value adds of Mantle specifically is when founders are navigating around, they can reach out to us, talk to our founding team or someone on customer success, and get a sort of unbiased third party viewpoint on, does this deal make sense? Like, is this really bad? Is this really good? And I think just getting that data point will get you to think whether or not you want to proceed or adjust, et cetera.
Perfect. Thank you. Thank you, Amit, for your expertise and time.
Sure, of course.
Awesome.
Let's.
I know.
Oh.
Sorry, yes. Go ahead, Amit.
Well, I just saw another question pop up. Like, I don't know how we're doing on time, though, because I see we're 2 minutes over.
Let's take this question and then maybe we can wrap up.
Yeah, sure. Okay. So let's see. What do you do if you wind up with 1% ownership of the things you can ask to stay in control, motivated? You ask for a high salary, buyback shares, a preferred rate, etc. So there are, unfortunately, there are quite a few scenarios where something like this can happen, where effectively the founding team gets diluted down to a very small percentage. This can happen as a result of down rounds or just way too many funding rounds, right? Like you have like 10, 12 rounds and you haven't been able to showcase some crazy growth. So there are several scenarios where something like this can happen. Now, what I've seen is an investor who is coming in later in your company and will recognize with your pro forma. Keep in mind, you're doing the pro forma for yourself. The investor is also doing their own pro forma calculation, right? Because they want to understand that after I write a check into this company, the company is going to be in a nice, healthy state. So they're aligned and motivated to make sure that you, the founding team, are in a good spot. So chances are you will be able to work something out with the investor where, to your point, there are many creative ways, be it salary based, be it recreating an option pool and granting option grants to the founders as a way to continue the motivation. And there's some very drastic measures as well, right? Now, this gets into legal territory, but we've literally seen companies do share conversion and a recap where they try to reset ownership a little bit. it can get really complicated and requires buy-in from all existing investors. But keep in mind, they're on your side. Hopefully, you've picked good investment partners. You're not just going with an investor who gives you money. And then the good investment partners will be aligned, and fundamentally, they want to help you. So they will find ways to make it work.
Awesome. I do want to be mindful of everybody's time, and it's 1:05. But Amit, there was another question regarding the pricing. So maybe if you want to clarify that,
Oh, yeah.
$100 per company, what's the pricing for the founder, individual founder?
Yeah, today we price it just by the company. So if you're a solo founder, you're welcome to sign up. You get the first year free. And then as you grow into it, the pricing might make sense. If you haven't fundraised, reach out to us and maybe we will continue on the free plan.
Awesome. Thank you so much, Amit. This has been wonderful. I had a couple of questions for you myself, but I'll hold on to that because I want to be respectful of everybody's time. Amit, thank you so much. As always, it's always a pleasure having you for our white space workshops and events. It's incredible what you're doing, and you always bring so much knowledge and value to these sessions. So appreciate you being here. And to all the founders who are in this room, thank you so much for joining us over the lunch hour and for all the engagement and the questions during the session. We do have our final session, a final workshop for the investment readiness workshop next week on 7th August, and we will be talking about exit. So how do you plan for an exit? So hope to see you guys next week as well. Thank you, everyone. I hope you all have a wonderful rest of the day. Thanks, Amit, once
Bye-bye.
again.
Thanks, folks.
Bye.
Thanks for having me. Take care.